the bullion banks over there, trapped by their own over-leveraged promissory notes, are unable to deliver on physical contracts. It would unleash not only true price discovery and maybe the real revaluation of real assets, but these banks don't just trade in gold and silver. These are like the Goldman Sachses of Europe. These are banks that trade in everything. It would set off a systemic chain reaction, and it could push prices of gold and silver parabolic. Because the truth of the matter is that real price discovery hasn't been allowed to take place in gold and silver really maybe ever. It's beginning to, because the only way that you can beat these players who have unlimited funds is to stand for delivery by players that have unlimited funds, and that is what is happening. The institutions across the globe, like all of the central banks, are quietly and slowly standing for delivery. It would set off a chain reaction that would be spectacular to watch. Not only could it bring down some of the biggest banks in the world, it would push prices to levels that people can't imagine. And for people to think that can't happen, and I may have said this on your show before, or I'm not sure if I did, but I would urge people to watch the show between Chris Marcus and Arcadia Economics and Bart Chilton. Bart Chilton also, right around the same time, did the same thing with Andrew Maguire. Did I ever mention that on your show?
Bart Chilton was a former director of the CFTC, which regulates the commodities. Yeah.
Did I ever mention that on your show, by the way?
You did mention, I think, okay. It might have been the last time or the time before, but yeah.
Yeah, and in it, he basically says that a large reason why Bear Stearns went bankrupt is because silver went from $21 from $12 to $21, and they had a massive short position, and it more or less buried them. So when you talk about this not happening, look, it could very well happen. And all it takes, or not even that, Adam, if one of these banks freaks out and says, this is just killing us, we are getting destroyed by the price continuing to move higher, and they break ranks and cover, just like that, boom, the whole thing falls apart. Kind of like the London gold pool fell apart. So I don't know. I think that for the first time in my career, all of the rhetoric talking about that, it seems as though not only does this administration understand it, they're taking steps to protect the COMEX by stuffing the vaults. And I do believe that there will be some sort of controls. At the same time, the target seems square on the Bank of England and the LBMA. So I think it would be something to certainly behold, not just in the gold market, but the reverberations through much of the financial ecosystem in the West, I think, would feel the fallout from that. The big money, Adam, always positions itself ahead of the crowd. And you can see the big money is doing exactly that. And I think that the fact that it continues to march higher is very telling without the public understanding. I want to read something to you that I think may help explain that moment, right? And it comes from all people, a central banker. And in 2023, I made a huge deal about this central banker and what he said. I'm going to read you what he said after I read you what was just quoted in investing.com about the Polish Central Bank and Adam Glapinski, the head of it. You think about a moment that could happen. Investing.com, Poland's central bank announced plans on Wednesday to increase its gold holdings to 30% of its reserve assets, aiming to strengthen the country's financial security. In these difficult times of global turmoil and the search for a new financial order, gold is the only safe investment for state reserves, National Bank of Poland Governor Adam Glapinski said in an emailed statement. He is proposing a motion to the bank's management board about raising the reserve target for gold to 30% from 22%. Here's what he said in 2023. Coming from a central banker, this caught my attention in a big, big way. And he said, why does the central bank hold gold? Because it retains its value, even if someone cuts off the power to the global financial system that is largely based on electronic accounting records. Of course, we do not assume that this will happen, but as the saying goes, fortune favors the prepared, and a central bank must be prepared for the most adverse circumstances. This is why gold has a special place in our currency management process. He's basically saying, so something happens that blows up the total financial system, whether it be some sort of an outage with the grid or some sort of an EMP. I don't know what the hell he's getting at, but to hear a central banker say, Yeah, a cyber attack. We do, because it's all based on electronic accounting records. I mean, come on. And that is true. Everyone's money is in the cloud, right? So that's why they own gold. So yeah, I think there could come that time where something happens like that. And you know, the name of my podcast is Little by Little. It speaks to logarithmic decay. Little by little by little by little, and bang, all at once. Where is that all at once moment? Is there an all at once moment? Sure could be. The biggest money in the world seems to be preparing for it, slowly accumulating it without anyone noticing. Well, they would do that before the all at once moment. You can see the little by little if you're opening your eyes to it. And when that all at once moment happens, yes, the market will be. And I've always said something similar to what Mike said. And I'm a fan of Mike. He's a smart dude. And that is that for people like the outsiders, people not listening to this show, the market will be defined by the price being too high, kind of the way that the public looks maybe at Bitcoin right now. For people watching this show, it will be defined by the inability to readily source product, because there are two major mints in North America, US and Canada. The US has been nothing but the model of inefficiency for the last, I don't know, since 2008, continually not meeting demand in a period of time where less than 0.5% of the public owns any. The Royal Canadian Mint, fine, a little bit better, but that's it. You have some refineries across North America. The majority of all the other gold is across the Atlantic. And once something wakes up the collective wisdom of the public, or the collective consciousness of the public to precious metals, just like that, the product disappears. We've seen it so many times, like during the pandemic, and premiums go parabolic.
Right.
The ironic thing of all of it is that it's the opposite thing right now. You have the largest exposure by the retail public ever in the stock market at about 56% ever. You have the highest amount of leverage in option exposure ever by the public, over $1 trillion.
Same with margin debt. Yep.
Yeah, and margin. And the same thing with option exposure. Options, margin, and all in on equity exposure as the insiders are selling and moving the other direction. At the same time, the biggest money around the globe, the central banks, and now the institutional money here in the United States, who are the smartest traders in the world, are all importing gold and silver. What could possibly go wrong, as the public has zero exposure to it and premiums are at the lowest level ever? It's the weirdest setup I have ever seen, ever. And I think it's a contrarian indicator to the nth degree of where things ultimately go. Gold's up 37% year to date, but it's averaged 9.9% since the year 2000, which has beaten the S&P 500 with dividends reinvested, which no one ever does. If they reinvested their dividends the whole way up, gold still has beaten it. And you know, since 2023, as I said, gold's up 100%, the S&P up 67%, amidst the greatest tech boom ever. And so when you talk about the fact that gold is the tortoise, doesn't get noticed the way the hare does, we have a whole generation of investors who think if there's not a triple-digit gain behind it, it's not worth it. So yeah, I do think that it has proven little by little. If I were to tell you what is the best performing asset since 1971, when Nixon closed the gold window, most people would not think gold, but it is number one. The S&P 2, the Dow 3, and silver 4. So since literally for the past 55 years nearly, gold has been the best performing asset cumulatively since that day, and it gets zero attention. But the central bankers, they all own it. They're all doubling down on it.
Right.
They know it. And so you don't buy it to become wealthy. You buy it because it is wealth. And that's the biggest issue, in my opinion. Speculators, after months of a little bit of liquidation in the gold market, where the speculators were taking profits, and gold kind of just chopped sideways, they are returning with massive open interest rising again in the futures market. What open interest means is people are coming in to buy more open interest. They're buying more contracts, and price is breaking out again as we see it nearing 27 or 3,700. This is the normal link between purchasing and higher prices. Okay, to your point, and you're the first person who I've talked to in a while that's got this. And that is that the silver rally right now is driven not by speculation, but I would argue this systemic short squeeze, because you have record high lease rates, you have falling open interest, meaning the speculators the hedge funds aren't buying. You have massive delivery demands, 58 million ounces since late August, 10,550 tons year to date. This points to a shrinking physical liquidity and mounting pressure on the market in London. London shows that they're trading 600 million ounces of silver a day, representing between 1 and 2 billion paper ounces. Claims 1 and 2 billion, and they have 140 million ounce free float backing that 1 to 2 billion claims and 600 million ounces a day. So it really means that London basically virtually has no free silver to meet rising investor demand and or back the billions of ounces in outstanding contracts. And with the lease rates at that level, it's basically the risk of a delivery default in London is rising. And that is the point where I do believe that what you just said is true, that there are traders that smell blood in the water with silver, and it is being pushed up because of the falling open interest, more by short squeezing than by anything else. And silver is something called a Giffen good, or Giffen good means that as prices rise, demand increases. That's kind of abnormal in investing. But it makes shortages even worse, because as the price rises, you'll get the industrials that say, man, we need to just jump on this now, like Tesla, because we need, so much silver and the price keeps going. Let's just jump in.
Right. They got to lock it in as a hedge. Yeah.
Yes. And so, yeah, really, 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 really good question. And I would say gold's open interest is massive. That's the central bank. Silver open interest is falling a little bit, but the price keeps rising. That's a short squeeze.